everyone, and thank you very much for joining our webinar today on ESG data. My name is Stephanie Greiner. I'm with the Solution Consulting team at Refinitiv. Before we start, I'd just like to go through a few housekeeping items and some technical notes. First, there is no dial-in number for audio, so please use your device sound and plug in your headphones to listen to the webinar. Secondly, click on the media player on your screen to enable the sound and video, and you have to ensure that Flash is enabled on your browser in order for everything to work properly for the webinar. If your slides that we're going to go through, if they become stuck during the session, please just refresh your browser at the bottom of your audience console screen. And if you have any technical difficulties during the webcast, there is a yellow arrow at the yellow question mark at the bottom of your screen. If you click that, somebody from the webinar platform will be happy to help you. There is a Q&A box in the upper right corner. If you please submit your questions to the speakers in this box, and presenter will try to answer as many questions as we can during the last 5 or 10 minutes of the webcast. If a fuller answer is required, or if we run out of time, we will make sure we answer your question via email. And finally, a link to this recorded webcast will be provided and sent to you via email at the conclusion of the event. Now at this point, I'd like to introduce our speakers today. First, Debbie Lawrence is the Global Head of Data Management and Content Strategy for Refinitiv. She's based in London. Also joining us today is Megan Starr. Megan is the Global Head of Impact for the Carlyle Group, based in New York. In Megan's role, she works to design and execute Carlyle's cohesive long-term impact strategy. She also oversees the dedicated ESG team, which leads the firm's investment diligence and portfolio company engagement work on material ESG issues. And finally, John Laufusweiler. John is a solution consultant at Refinitiv with primary focus on ESG methodology, and Lipper. And John is based in Los Angeles. John does primarily cover Refinitiv's ESG proposition and the ESG scoring methodology. At that, I'd like to turn it over to Debbie Lawrence to start the main part of the webinar. Thank you.
Great. Thanks very much, Stephanie. And thanks, everybody, for taking the time out of some very busy schedules, I'm sure, to join us today. And special thanks to Meg for agreeing to participate in the session. As Stephanie said, I head up the data management and strategy function. And as a result of that, I'm incredibly interested and possibly quite biased towards the challenges we have in the space around the collection of data. So you'll see a little bit of a bias towards some of the questioning of Meg related to the growth of ESG data and how vendors collect data, and naturally, incredibly interested, obviously, in the consumption of that underlying data as well. So again, if you've got any questions directly, please do put them into the chat. Welcome an interactive session at the end of this. So, with the huge tsunami of an interest in our ESG data around the world, with over 2,000 asset managers and owners who collectively manage the number that comes to mind is about 75+ trillion in assets. The importance of the data is becoming bigger and bigger and bigger, and there just seems to be a never-ending supply of this data over the last few years. Stats like 85% of S&P 500 index companies publish sustainability reports now, which is a huge increase from my experience in the last few years, where it was really just a few thousand companies globally that started reporting in the ESG space, and finding and getting access to sustainability reports was incredibly hard to come by. And if I look back through my career at Refinitiv, when I first took over the role and obviously took responsibility and some insight into our ESG data, it took approximately 3 to 4 days for us to collect data for one company, simply because of the wide breadth and dispersity of where we actually found data and had to access data for. That's obviously come down over the years, but it's still a challenge in the industry. So that leads us into one of the first polls that we have in the session. Please do participate, and which pillar within E, S, and G is the most challenging to draw insights from: the environmental pillar, the social pillar, or the governance pillar. So please do enter your response to that now. I'd be very interested to see the results. I'm not quite sure if I click on this now. Social, that's interesting. Okay, super. Thanks very much. Maybe Meg, you and I can explore that in a little bit more detail in our questions a bit later. Okay. So one of the areas that we're seeing a growing interest, particularly in the EU, is around the data collection challenges. And there are obviously multiple industry frameworks in existence. There's SASB, GRI, but there's no single globally aligned reporting standard for ESG data. ESG data for public companies is reported across multiple sources, including corporate sustainability reports. Data is embedded in annual reports, emission disclosures, company website, and there's no single source containing all the data that's required. And as a result, vendors like ourselves have to go to between 5 and 40 documents to capture all of the data that's required. And unfortunately, ESG isn't mandatory like it is with financial disclosures, although obviously there's increasing pressure to publish data in corporate sustainability reports. So reporting standards and patterns vary from company to company, which makes it a challenge for vendors, and large cap companies produce a lot more data than the small cap companies. But the noise is coming out of the EU around standardizing that reporting is an interesting thing that I'll be exploring with Meg in our interview session. And then obviously the regulation comes into play. Again, a slight bias in the EU, just because that seems to be where a lot of the regulation seems to give, a lot of regulation is given birth in the EU, and then it becomes, a global phenomenon. But again, that's a big part in the number of data items that are reported by companies in this space. And as you can see, the trend is almost exponential over the last few years around those data items. So there's obviously the topic of materiality is very subjective, and there's no industry agreement on which ESG measures are more important for companies to disclose. I think everybody will have their own opinion on which measures are more important. Refinitiv, we believe that ESG data is fundamental data, which stipulates it must be factual, auditable, and objective. And our proprietary scoring methodology uses materiality weightings, which take into consideration the importance of certain factors across different industry sectors. We apply those weightings to data measures in our model, and any company not reporting immaterial information will not see their scores impacted, whereas non-disclosure of measures that we consider to be highly material will have an impact on the company's scores. And below are a few examples of industry-specific metrics of importance to specific companies. Okay. So ESG data quality. Obviously, Refinitiv uses the underlying data to derive a number of different scores, and as a result, the quality of that data is incredibly important, simply because the way those scores are used to rank and compare companies, and ethical investors can use negative screening data measures for their exclusion criteria. So the quality of the data is incredibly important, but more importantly, it's to ensure that the data items are the same and consistent, and where companies call a certain field something in a report, is it exactly the same as another company? Again, that comes down to the standards of reporting and ensuring that you are doing a like-for-like comparison, especially when you're incorporating those scores into something as important as a score and as a ranking, which can drive, index usage. There are a whole host of examples where if that data quality is not 100% accurate, it could have a detrimental impact in the amount of investment that that company might see, depending on the index decisions that a company might be making. So, for example, whilst researching whether a company has policies around sustainable packaging and water efficiency, we not only look for policy statements, but we also determine the processes that the companies have in place. And in the good example, companies don't describe its policy, but also provide examples of steps being taken in sustainable packaging, for example. And in the bad example, the company simply states that sustainable packaging is important to them. But we need to have examples to really determine, the underlying nature of their reporting numbers and ultimately the impact of the scores. Right. So on to the second poll of the day. Can the use of ESG data in your investments help in improving sustainable returns of the company? Yes, no, or not sure. Can the use of ESG data in your investments help in improving sustainable returns? I'm glad to see that there were no no's. Thank you very much. Right, so let's get on to, I've set the sort of context for some of the questions that I'll be asking Meg. So let's start with the interview, and then we'll go on to a demo of how our ESG data is presented in some of our products. So Meg, as I pointed out, there seems to be an insatiable appetite for ESG data. And as we're seeing from our perspective as a vendor, as a market participant, however, I'd be interested to know your thoughts on this growth and whether you have an opinion on relative importance across E, S, or G, in particular in the investment process that you obviously go through on a day-to-day basis.
Great. Thank you so much for having me. I totally agree. And I think everyone on this webinar has seen the explosive growth, even in the past year and a half, 2 years again, of interest in this space and data providers and different information to sift through. And while that's both challenging because there's such a wide proliferation and there's a wide proliferation of quality, that's also a huge investment opportunity because we're seeing that if you're able to parse through that data well and actually draw out material insights, that can really drive value creation in your investing process. I actually think that COVID was a really great example of where we saw that ESG competencies in management teams and companies were actually a proxy for management excellence. And so it was the teams that were already forward thinking, that were agile, that had a great handle on their supply chains, their labor, et cetera, that were able to really weather that storm well. And so I think COVID was a great example, and I think it's analogous to other exogenous shocks we see to business, such as the climate crisis. And so this concept of ESG actually being indicative of how you're able to steward your company, I think has really come to the fore recently. And you talked a little bit about the kind of relative importance, and I think one observation I had was at the beginning of COVID, people said, oh gosh, is ESG suddenly less relevant? And frankly, we saw the opposite. The interesting dynamic we saw was it wasn't that climate change became less important or that environmental issues became less important. It was just that social issues really came to the fore because it was one of the first times that we saw globally and quite publicly that companies that were really able to manage their people, manage their supply chains, and really take care of them were able to excel. And I think that the challenge and conclusion is that how do you find these new underutilized material data sets and apply them to an investment process? And when we were prepping for this, I was kind of thinking about the anecdotes about, hedge funds using alternative data like satellite imagery to look at trucks going in and out of depots to predict sales volumes. I think ESG is at that point, and we're ready for that, of saying, how do you find these new and these innovative data sets that are actually giving us material insights about business performance?
That's really interesting. And an interesting insight from the COVID perspective onto the social aspects of the E, S, and G versus the environmental, which was obviously so topical pre-COVID, climate change, etc. You didn't have to sort of come out of any Davos meetings, which was only in February. COVID hits most of the world in terms of lockdowns in March, and suddenly you've seen an about turn. That's very interesting insight. You mentioned the varying degrees of quality in the data and the fact that you pass through the data looking for that. What tools do you use in that particular screening process with regard to that data? So how do you go about it?
Yeah. So I think there's a constant tension in the ESG space, and it's kind of this argument of, Do you need material bespoke data that's tied to an individual company? Or do you need data that is broadly comparable across a range of companies, different industry sectors, geographies? And I think where we come down is that you really need both, because they each play different roles in the investment process. So on the material side, we use the SASB framework, which was built to mimic FASB. It has been a great proxy for honing in on what are the material bespoke issues that are really relevant for a given company, given its industry, sector, geography. That's been really helpful because it helps us drive efficiencies in businesses. Where can we reduce costs, find better ways to produce for a unit of energy? It's increasingly helping us drive sales volumes because customers value those traits. And if you can articulate them and measure them, that can really help with growth. But interestingly, it's also really been helping us with financings. So the material ESG metrics we've been tracking for some of our companies have helped us get financing linked to hitting ESG targets recently. So one example is a Spanish-based company called Genealogia. It's a denim finisher. It finishes denim for the garment industry. It was one of the largest contributors to greenhouse gas emissions globally. And Genealogia's technology uses about 85% less water and less chemicals to finish denim than peers. We've been tracking that data over time. We have targets about reducing it. And so they were able to own this past winter that was linked to hitting those water reduction targets. And so they hit those targets, the pricing ratchets tighter. If they miss it by more than 15%, the pricing ratchets up. So that's a great example of there are a lot of applications for the material bespoke data. But we also know that there's some issues that are systemically important across the globe, and we need to understand trends. We need to see what we own. We need to understand exposures. And importantly, we need to start doing real research about where there are correlations with financial performance. So we did some research this past winter because we collect pretty granular board diversity data across our portfolio companies. And as a private equity investor, we obviously have very granular financial data. And so we were able to find that over the past 3 years, our companies that had at least 2 diverse board directors had about 12% faster annualized earnings growth than our companies that didn't have diverse boards. And so I just give that as one example of why there's utility in having broad-based data that you can look at across companies, but that it's really a complement to also having that bespoke material data.
That's really interesting. On the diversity of the boards, when you see the results of the improved performance, do you dig any deeper with those companies to understand, some of the other factors that might be contributing to that versus just looking at the diversity?
Definitely. We work to control that by fund, by geography, by size. And we were actually able to isolate it where each individual diverse board member was associated with about a 5% increase in annualized earnings growth. So we always have the challenge of correlation. But I think, again, it gets back to this idea of ESG competencies being a proxy for management excellence. And I think there are a lot of things that get wrapped up in this idea of teams that are forward thinking, that are dynamic, that value a diversity of opinions and views because they see that leads to better decisions.
Interesting. Great. And then just quickly on the subject of the standardized reporting that I've mentioned a few times in the opening preamble to the session, I realize that there are lots of positive signs coming out of the EU on this topic, and from a Refinitiv standpoint, we certainly would support it. It would make the collection of data much easier. We'd be able to scale across more companies. And again, to that point I made around ensuring that actually we're comparing like for like, that would give us a lot more confidence. So I have 2 questions for you. Firstly, do you have an opinion on how important this is for the industry? And secondly, how quickly do you think the US might follow in their footsteps and regulate the reporting?
Yeah. So I would say it's been a huge topic and a huge focus because we see kind of really increasing regulation globally in different markets around ESG reporting. I would say from our perspective, though, I don't think the world needs another ESG framework. What we need is a critical mass of companies reporting the same data, be it for their industry or be it across all companies, and in the same format. And so I think there are a lot of forces that are heading towards that goal. Regulation is definitely one of them. And I think the EU regulations are indicative of that desire. But we also see a huge amount of investor pressure looking for that. We also see a huge amount of pressure for companies from their employees, both internal and prospective employees. I think another really big force that we've seen is, frankly, what the market is pricing in. There's one great example. We did some other research this winter about oil and gas companies, because when you think about the energy transition, a lot of times the story is just focused on renewables, and that's a huge part of the energy transition. But I think we're also seeing that there are clear financial indicators that a broad array of companies that are on the forefront of the energy transition are really being rewarded by markets. And so we found that if you could take an oil and gas company from 0% revenues from renewables to 40% revenues from renewables over your hold period, you could almost double your trailing EBITDA exit multiple. And so I just add that data point in where it's both a combination of regulation, but increasingly it's market pricing, it's investor pressure, it's employee pressure. And so I think all of these forces are combining into saying, again, we don't need another framework. We need a critical mass of data in the same format disclosed by companies so we can really start using it to parse through.
So sorry, not to put you under pressure. Are you suggesting that it becomes almost an industry drive to standardize their own way of reporting versus a regulation imposed on the industry? Do you think they'll do it on their own?
I think all those forces are working in tandem, and so I think are working towards the same ultimate goal. I know personally we're a public company, and so we have to navigate our own ESG corporate disclosures in addition to whatever ESG data we're collecting for our underlying portfolio companies. And even from our perspective, we have dedicated ESG team in-house that I oversee. We have people who spend their waking hours on this. And it's still challenging to figure out what disclosure system to use. Currently, we're using GRI and SASB, but I think there are so many different stakeholders that are all angling towards the same thing. And so I don't know what will be the kind of final push, but I do have great faith we're all heading in the same direction. And so it's just a matter of finding a solution that you can get a critical mass of participants behind.
Okay, good. Thank you very much. So 10 years ago, and possibly not even as far back as 10 years ago, ESG was probably, put in the bucket by many as sort of an alternative data, an interesting data set that might or might not enable you to find alpha. But now it's pretty much mainstream, and I think that's generally accepted that it's mainstream. What other data sets do you see growing in importance in this space over the next 2 to 3 years? And what alternative data sets within the ESG, and what are the alternative data sets within that ESG space?
Yeah, I think I love that this field very much used to be perceived as an ethical or morals or philosophically based field. And for a lot of investors, it was about personal preferences. But I think the fact that it was dismissed by a lot of mainstream finance for so long has actually been part of what makes such a huge opportunity, because these data sets that were once considered non-financial are actually quite financial. And so the people that are able to discover them and utilize them and aren't getting, sidetracked by ideology can actually find real value. I think I've been really excited by a bunch of scientific data sets that I've seen coming out. I was meeting with a group of hydrologists and geologists a few months ago that were building a much better system using satellite tracking and alternative and AI to really start to understand floodplains. Because the FEMA flood maps can be really out of date in certain geographies. And so I think that's a great example of, if you can actually build this system that is more accurately assessing sea level rise, extreme weather-related events, the vulnerability of properties, that has huge financial implications. I think the key is, how do we take these incredible scientific discoveries and translate that into investment application? So how do you take these geographically based data sets and tie that into the property, plant, and equipment for public companies or the location of private entities? I think the other set of alternative data that I really find interesting is around human capital. I think we are just in the early innings of really understanding how we can better quantify and better optimize for things like employee satisfaction, employee engagement, employee health. because those things all feed into turnover and productivity and long-term growth potential for companies. And so I think the days of seeing humans as, lines on your income statement or as a cost, those are really quickly behind us in terms of saying, how do we focus on making sure that people feel engaged in their jobs and have good jobs and have the right skills for the jobs that are open. And so I think we've seen some interesting evolution there. And the last bucket I would say is that there are a couple of nonprofits like Just Capital, who I think have done a really good job of saying, how do we actually use a scientific method to survey a broad base of Americans to say, what do you think of as just corporate behavior? And then how do we scrape these alternative data sets like OSHA labor violations, or, they're finding a host of things to scrape to actually kind of rigorously rank companies based on that. Because again, that's an underutilized data set of what do you and I think about in terms of a company that we want to go purchase from or work from or support. That actually feeds into that company's long-term value. So I think we're at a really exciting point of there are all these different interesting innovations, and we're starting to see how those can translate into mapping to investment applications. But the other interesting thing is that the goalposts are always moving in ESG, because as alpha signals get discovered, they get priced in. And so there's always the kind of hurdle of how do you find what's new.
So do you see that trajectory of that graph that I had in one of the previous slides continuing to go up, or do you see it plateauing?
I see it continuing to go up for now. I think at a certain point there will be ESG data fatigue. And so we'll really start separating the wheat from the chaff in terms of what data is actually useful and meaningful, and what data are the more binary factors of yes, no, you have a policy, yes, no, you disclose it, that don't really correlate to what a company's doing under the hood.
Interesting. No, I mean, we have the similar conversations internally and naturally sort of aligned to the whole alternative data discussion around, how quickly is this all going to grow? And then I like your word fatigue. Do we move on to something else? Just like, ESG was in that bucket probably a few years back, and now it's sort of everybody's talking about it.
Yeah.
I love the idea of the human capital aspect that you just referenced. That would put a lot of pressure onto some organizations around their employee satisfaction if there was an expectation from both shareholders and the employees themselves that it becomes a publicly disclosable data point. Yeah, definitely. I think of it a little bit as there were different investing styles that I think about. For example, value investing that really came into vogue, in the early 1900s, but then really the 1970s. And it was, this incredible kind of new field of saying, actually, you can derive so much alpha through this concept of value investing. A lot of that got priced in because people realized it. That doesn't mean that there aren't still great value investors. And so I see the same thing happening in the ESG space of all of a sudden it's really become at the forefront. We're in process of a lot of the low-hanging fruit getting priced in, more efficient business models that use less energy or just better businesses. But that doesn't mean that there won't always be great ESG investors, but they're the people that are looking around corners that are seeing what's coming and really trying to always be moving the goalposts further. Yeah, I mean, bottom line, it's transformed the industry, and there've been, the naysayers of the past have become yay-sayers. So I think it's all been great, and it's been a very interesting journey for both vendors like ourselves and industry participants like yourself. Meg, thank you very much. We're going to pass over now to Jonathan for the demo, and I'm sure there are going to be loads of questions at the end for you and I to pick up on.
Sounds great.
Okay, so we'll move into the demo now. Before we get there, we have another poll question which I'll post, and I just want to comment once. There's several questions that have come in on will the slides and the recording be made available, and the answer is yes. At the conclusion of the webinar, shortly after, you will receive a link to the full recording of the webinar as well as the slides. So there were several questions that came into that. So just wanted to comment there. So on to the poll question. Do you incorporate ESG content as part of your post-trade portfolio analytics? I'll just leave that up for 5 or 6 seconds. Let everybody give us an answer. Okay, so interesting. We don't have anybody on the call that uses ESG data as part of portfolio analytics. So I'm going to now turn it over to John, who can go through a demo of how some of the ESG data can be utilized in analytics in ICON. So over to you, John.
Yeah, thank you, Stephanie. Hi, everybody. My name is John Loffersweiler, and today I'm going to be taking you through just a quick demo of one of the ways in which you can use our ESG data within our Refinitiv Workspace or ICON platform. There are a number of different ways that you can utilize this, but today specifically we're going to be looking at portfolio analytics. So the first thing we're going to do, this first screen here, just showing how to access the app in our top search bar. You're just going to be typing in the short key port, the application. And if I move through here, this is just what the overall landing page will be for that portfolio analytics page. It'll just pull up a specific portfolio and a specific template that we already have pulled up. But specifically today, we're going to want to be looking at our optimization tool. It is a feature within our portfolio analytics tool that allows you to construct a portfolio to minimize total risk or minimize tracking area with a constraint in place. In this specific case, we're going to be looking to minimize the total risk of a portfolio and then add ESG scores as our constraints so that we can tilt the portfolio in that direction. So once we click on this optimizer tool, it might be a little bit hard to see in terms of these specific details, so I'll try to talk through them, but it's just going to bring you an overview page of a specific portfolio that you have pulled up, but we're going to be going and clicking into the portfolio construction button here and kind of specifying our own portfolio. So once we do that, it'll bring us to a settings page. A lot of different options here. I've just kind of highlighted some of the ones that we're using in a specific example. For example, the trade universe, we're just using the S&P 500. You could use other indices if you wanted to, or a specific list. And then on the bottom left-hand side, we have our available items in terms of data points that we can set constraints for. The first of which is base constraints. So like I mentioned earlier, we are going to be using total risk as our kind of overall portfolio construction. We want to minimize that risk of the portfolio. And then we also added in a minimum trade percentage and added the parameter of it being just 1. So that's just going to avoid really, really tiny trades within this portfolio. Next, we're going to hit this drop down here to company information. That's just another section of available data points we have for our constraints or available items that we can put into this report. I've selected ESG score. As you can see over on the right-hand side under the parameters column, for the last fiscal year, I'm going to be having a minimum score of 70 out of 100, be that the stocks to be included in this portfolio. Now, if we move on, it might again be a little hard to see, so I'll kind of try to explain this. We have back to our optimization page. At the very bottom of the box, you'll see the specific portfolio construction based off our criteria. So we wanted to minimize the risk before the optimization. I believe it was 37 points. Now we are down to about 12, giving us a 12-point change, 25, giving us a 12-point change there in the ESG score. Before it was just a little bit below 70 at about 67 out of 100. And after the optimization, we are above 73 points. So a decent change there. So we do see that the optimization tool is working in the way that we first intended it to. After that, I'm going to go to the export button so that we can really see analytics and reports based off of this portfolio. And just is going to have us specify a few more things like the benchmark. We're specifying it to be the S&P 500. And in the bottom left, we want that portfolio inception date to be as of 12/31/2019. So we have a full, since the all of 2020 as this data that we will have back to. We'll be able to select our portfolio and start building out analytics and reports for that. So we're going to select our portfolio, should be under the recently selected my optimization portfolio there. Now we are going to be basically setting our parameters of how we want to be seeing this data. So again, I'll kind of explain some of these drop downs on the left-hand side. First of which is the benchmark. That's just, we've already specified that it's going to be S&P 500. The next are our classifications. So we did 2 different groupings here. We did the ESG score grade and then also the GICS economic sectors. That way we can really look at attribution or contribution, whatever it might be, into the specific reports and specific tiers or groupings are really driving those this performance or the portfolio weightings or whatever it might be. We have the as of current date, and then the specific time frame that we'll be looking at is going to be the month of July. And then lastly, in the bottom left-hand corner, you'll see our templates. I have highlighted the ESG performance template. That's one of our pre-canned templates. We have a lot of those. This one is just specifically geared toward ESG performance. So now I'm going to populate this report, and based off that criteria, I'm going to be getting all my results here. As you can see, kind of on the top ribbon, I have ESG score, that tab selected. That's what we're currently looking at. There are a lot of different views of this data. Today, we're just going to be looking at the ESG score and then the performance tabs. First off, we'll go down, as you can see, the page is kind of numbered. We'll go through each of these boxes or kind of tables here. Number one is just going to be an overview of the specific portfolio. We'll see the name, the benchmark, the number of securities within this portfolio, and then also looking at how much of the benchmark holdings we have, and then the ESG score and the ESG combined score. The combined score also has controversies of the specific company included. So you'll see the ESG, we will see that the ESG score and combined score both outperform the benchmark, which is good news. This is what we were intending to from the start. Now, in terms of portfolio weightings, the next table down, number 2, it's broken out by ESG score grade. So if we look at the A scores, it'll say that we have about 40% of our portfolio in that score grade, comparatively to about 19% of the benchmark. So we were really heavily overweighting in the A rated space, and just kind of the difference in ESG scores there as well. Down at the bottom, number 3 is going to be our ESG pillar score. So we do have our E, S, our G scores, our combined score, as well as underlying pillars such as emissions or human resources, whatever it might be. We'll see our individual scores in each of those pillars from our portfolio comparatively to our benchmark and the differences there. And then that chart to the right of there is just basically that data in graphical form. Now, if we move over to the performance tab, we can see how this actual portfolio is performing against the benchmark. So in the top left graph, we're going to be seeing colored in green, both the line and the bar is going to be our portfolio performance. And then the blue line and purple bars are going to be the benchmark performance. As you can see here, over the first week or two of the month of July, the portfolio was underperforming the benchmark and then had a rally in weeks 2 and 3 to surpass and end up performing above that benchmark for the month of July. The table to the right of that graph will just show a week-by-week performance, and you'll be able to see, if you can see the numbers, that weeks 2 and 3 were the highest performing there for our specific portfolio. In the bottom left-hand corner of the table there, it's broken out again by our ESG scores, and we are basically just looking at how each of those scores have performed within the portfolio, and also our active weight and our current weight of companies within that specific score grade. And as you can see, the A rated has heavily outperformed the rest of the score grades, which is kind of doubling down, saying that not only are we being an ESG conscious portfolio, but those heavily rated ESG companies are actually what's driving a lot of our performance. And if you can see the overall contribution effect in that table, it's really one of the only green lines in that last column is showing for the A-rated companies. And then lastly, in the bottom right, we'll have our specific, the underlying holdings that are driving that growth. And you see the Unilever is the highest performing one there, and then it's also an A-rated security. So that's always great to see. That's essentially all I have for the overview of the specific template. Again, there's a lot more ESG data we can dive into, not only on a portfolio level, but throughout our Refinitiv Workspace platform and our Refinitiv kind of suite of products overall. This is just one specific use case that I kind of wanted to show kind of the capabilities here. So I think we'll open up to questions now, and thank you for your time.
Okay, thank you, John. So now for Debbie and Meg, I'm going to go through some of the questions that we have here. And again, like we said, we'll get through as many of them as we can. We thank everybody for their engagement on the questions. So the first one, how are you seeing firms quantitatively track companies and their progress toward ESG goals? So for example, if a company hits the no poverty or quality education goal, how do you track that progress quantitatively year over year? Meg, do you want to?
That sounds like one for you.
Yeah.
Sure, I'm happy to take that one. The SDG, the UN Sustainable Development Goals, are another topic within the ESG world that have really emerged and come to the forefront in the last 2 or 3 years. And my hypothesis for why that is because I think a lot of times companies or investors look at the whole spectrum of what ESG can mean. So many different data points or factors, and it's hard to say which ones you need to focus on or care about. But I think the SDGs have been a really helpful unifying force for global stakeholders to say, these are the 17 agreed upon goals that we know we need for a sustainable future. And so I think they've just been a helpful way of taking the ESG world and really saying, like, these are the things we need to focus on. I think they can be really challenging because the SDGs were created not necessarily as an investment thesis, but as goals that take a whole host of stakeholders to achieve. They take public policy and governments, they take philanthropy, and they do take private capital. And so I think the first step is understanding which SDGs really map to using private capital to solve them. And then I think from the quantitative standpoint, that's a much trickier question of how do you understand a company's contribution or maybe detraction from those goals. I think as a first step, we've seen that understanding revenue sources has been a good proxy for understanding where a company is deriving value from and if that maps to the SDGs. But I would just put in one word of caution that I think the SDG be a really helpful output for looking at your portfolio and looking for companies. But I think using them to guide your investment thesis isn't potentially what they were intended for. So I would say we're still very much in the early innings of how you can actually get quantitative data that maps to the SDGs. But revenues has been a good proxy in the early days for understanding kind of where a company is deriving the most value.
Okay, great. Thank you. Thank you, Meg. Another question. Do you have any kind of high frequency data to integrate into predictive models of equity markets in the short term? Debbie, I don't know if you want to take a first pass at this in terms of how Refinitiv offers ESG content and the various ways in which we do.
Yeah, so I mean, ESG by nature isn't a data set that I would deem high frequency in terms of sort of the update rates through a year. We obviously, most companies update their ESG reports on a yearly basis. I would hope to see that trend move towards more of a quarterly one to align with their quarterly reporting announcements. We do update any sort of controversies from our news feed, but obviously there's a lot of other high frequency type data that we have across Refinitiv that might play into an ESG analytics, such as some of the data that we would update from our pricing feeds. Some of the commodities data is becoming more and more interesting in this space, particularly in the sort of the sort of oil and some of the sort of mining space. But again, I suppose it comes down to terminology. In my mind, high frequency is the update rate, which would imply some kind of pricing mechanism versus something that's reported by a company, which happens on a far less frequent basis. I don't think I answered the specific question. It'd be good to get a bit more context from the person that asked the question, if possible.
Yeah. Okay. And just to Debbie's point, yeah. I mean, it doesn't tend to be a high frequency content set. However, we have in our back testing tools, in our quantitative analytics direct tool, we do have. Clients do have access to ESG content in those tools, and they can be used to create custom factors, etc. So yes, thanks, Debbie. So the next question, probably one for Debbie and maybe John. How does Refinitiv's data collection and ESG scoring methodology differ from peers like MSCI, for example?
I think I'll let John take the analytics one, and I'm certainly not an expert in our scoring methodology, but certainly the approach that Refinitiv has taken in from a differentiator to other players in the markets like Sustainalytics, MSCI, is at the core the raw data, right? So we see ourselves primarily as a data provider, and ultimately that data then would feed into analytics. And, we've partnered in terms of our exact scoring methodology. I could certainly find out some specific details for it unless Jonathan has the information. But it's ultimately the underlying sort of views and weightings that we would put on that materiality that we were talking about a little bit earlier. I think that's ultimately where some of the underlying differences are. But clients, Sustainalytics, MSCI primarily see themselves as an analytics provider, whereas Refinitiv sees ourselves as a data provider, if that makes sense, Stephanie.
Yeah, and John, I don't know if you have any comment, but also in terms of Refinitiv, we pride ourselves with ESG in particular that it's very transparent. The way in which we calculate the ESG scores, it is made fully transparent for our customers. So there's no misunderstanding or vagueness as to how these scores were developed. John, do you have anything to add?
Yeah, I mean, just to piggyback off what you were saying, Stephanie, the number one thing we like to say is it's all completely objective. We're very transparent on where we get that data from. For example, within Refinitiv Workspace, if you're looking at a single company view, there's a hyperlink to every single policy or specific number that we have within that we have for that company database back a number of years since we've been covering them, and it'll give you the direct source, either the website or the article of the controversy or the specific policy or the annual report of a specific company. So a lot of transparency. Everything's objectively based and just giving kind of the raw data to use how you'd like it.
Okay, very good. Thank you, John. So another one here. How do you justify that Refinitiv ESG data are yearly and not monthly, for example? I think the question. I mean, Debbie, maybe you have a comment. I think the question is, much kind of the earlier question. Much of this data is not high frequency.
Yeah, most companies only report on a yearly basis, or certainly within one fiscal period, and that's our commitment from a data standpoint. We obviously update anything from a controversy standpoint. If something hits the newswire, we will update it accordingly. We are having some conversations internally about whether we should be producing sort of partial ESG updates. So naturally, we try and look for a complete collection of data assets, data items before we sign it off and put it into production, understanding that it ultimately powers scores, the underlying scores. And if you're missing an item, it won't trigger the score. So we are having some conversations around producing partial updates. But naturally, the industry, I don't think, has matured to the point where we're seeing enough frequencies within the year to justify that just yet. But we're keeping our eye on it. But at the moment, the view is that most companies don't update more frequently than a year. The biggest challenge we have is that obviously some reports come out within months from each other. So there might be a perception within the industry that they're reporting more than once a year. But as a data provider and a data aggregator, we need all the data items to be able to call the company a complete update, if that makes sense. So there is sometimes a lag of months between reports being generated by a company. Meg, I don't know if you've got any insights into that from a sort of frequency of reporting standpoint from the companies.
Yeah, I think what we've seen is that in order to get comprehensive data, it's really helpful to refresh once a year, just because to do it well takes so much time and so much effort. There are certain issues that we want to look at more on a quarterly basis, and I think sometimes that can be more routine data feeds. So I was thinking about things about employee turnover or data that's more automatically generated. We also want to know about material ESG incidents on a more timely basis, because those can have a real impact on financial performance. So I'd say in terms of the longer term factors that are more associated with growth and where you can find alpha, a year tends to get us the best quality data. But in terms of the risks and particularly incidents, that has kind of more utility if we can get it more frequently.
Yeah, so and so just to make sure we're using the same terminology, that's the controversies aspect that I was referencing. And when it comes to what I would call the more fundamental data, employee turnover, we naturally update that on a quarterly basis. In some markets, a monthly basis, depending on how companies choose to report. But that's more what I would deem our fundamental financial data that comes as part of a different product. But naturally, in a product like Icon, a lot of the data comes together as one.
Yeah.
Okay, great. Thank you. So here's one. I'll read the question. In the subject of diversity in the upper management and board of directors, how clear is the data on correlations between diversity and growth or revenue versus the causality that's derived from long-term commitments to integrating diverse members?
So I think Meg picked up on this in one of her answers earlier on.
I would say it's a great question. I don't have a great answer in terms of how that kind of specific question. I think what we found is that we need more diversity data, but we also track diversity data for the C-suite and direct reports to the CEO. And so we're trying to get a more holistic measure of, the board's a great place to start, but actually how does that translate down into the full company? And there are other factors that you can look at as well in terms of, do they have a diversity policy, particularly in the US, do they have paid family leave, et cetera. And so I think it can be hard to pull out exactly what factors have a directly causal relationship with financial performance. I think what we found is that they're indicative, again, of being thoughtful about how a diversity of opinions and perspectives and backgrounds can lead to better decision making. And again, being thoughtful about how you're treating employees and taking care of them and really making sure you have an engaged and healthy and productive workforce. So I don't have a great answer about kind of what specifically ties, but I think in some ways, you don't necessarily need to know the specific causation, but you do need to have indicators that show you when a company is on the forefront of this issue, because that is associated with greater financial performance.
Okay, great. Thank you. So here's one. I'll just read the question. I'd be happy to hear your comments on ESG data and Wirecard.
Oh. Not one I'm aware of.
Megan, is that something?
I think it's ESG debacle and Wirecard, right? Is that something you're aware of,
Yeah.
Meg? I'm not. Sorry, Stephanie.
Yeah. Okay. If the person who posed the question, if you want to send another question that maybe will help us to clarify, we'd be happy to answer, or we'll get back after the webinar. Let's see. Looking beyond corporate data, is it possible to get sovereign ESG data? In other words, are there ESG scores at the sovereign level?
I'm happy to take that, and I apologize before my page was frozen. At the sovereign level, we have seen some really interesting data sets, particularly around country level risk. And I think that's a helpful backdrop where it just helps guide the conversation and guide diligence. And so there are actually a lot of really great publicly available data sets on that as well from the IMF and different groups. And so I would say we use those in combination. So it's both the industry specific issues, but then also the country or sovereign level risks, because it really matters the context in which a company is operating.
Yeah, agreed. I mean, Stephanie, it's probably too late to put Jonathan under the pressure to quickly show the sort of country risk analysis that we have in Icon, but that's a huge focus for us, particularly out of some of the COVID analysis that we've been doing and the credit crisis that potentially starts, to come into play. That's an area that definitely is becoming part of that sort of broader conversation at our level around country risk, and you'll see a lot more coming out from us over the coming months as we pull more and more investment into that. And we're trying to do a bit more around the predictive analytics in the space as well with Starmine to come up with some predictive views on the country at risk.
Okay, thank you, Debbie. So here's another one. Can you discuss if and how customers use the data to monitor client restrictions like gambling, tobacco, et cetera, or is it solely used for the investment decision-making process? Megan, from your perspective, maybe you can comment on that, and then we can.
Yeah. So I'd say, unfortunately, we have a little bit of an easier time because we're not public market investors. We're private equity and private credit investors. And so we don't have the same challenge of, holding a portfolio as diverse as the S&P 500 and trying to keep on tabs on what companies might be involved in certain issues. So we're able to do that as part of our diligence. And we have a set list of sectors and industries and practices that we think are fundamentally misaligned with our values and where the world is going. So we're able to understand because we do such in-depth diligence on private assets. And so I'd say we don't necessarily have the same data needs as public market investors do in terms of making sure that they're abiding by client guidelines.
Yep. Okay. And John, I don't know if you have any comment, but within Icon, if you're looking at the analytics, I mean, you can indeed look at a portfolio or an asset's exposure to various ESG components. So you can look at kind of how your portfolio is exposed. You could also use screeners to screen out. So it is a combination of people using the content to screen out or stay in compliance with various restrictions, and then also others in tandem or separately use ESG data as part of the investment decision making process.
Yeah, absolutely. I mean, people use our ESG data a number of ways. As I mentioned at the beginning of the demo, there are a couple of other applications in which you can use that. As Stephanie mentioned, for screening down, you can set criteria on any of our ESG data points, whether it's on an overall level or granular into the specific pillars that I suggested. And there's underlying data points even after that. We collect about 450 total data points within our ESG kind of proposition. So we'll see people use them on an overall level. People use them on extremely granular. They'll just look at carbon emissions data points if that's something they're interested in. It's really just a case by case situation.
Okay, thanks. Another question came in. Do you see companies in China less open to ESG disclosures? Debbie or Megan, do you have a comment?
Oh gosh, and it's not an area I'm a particular sort of specialist in. I think there's pressure on China to make the information available. I'll be honest, getting a lot of information out of Chinese companies isn't always the easiest place to go, but I think the industry pressures are there. And Meg, you might have a bit more of a particular insight, but apologies, Stephanie, it's not an area I know particularly well at all.
I would think this from the kind of geographical perspective. Obviously, the EU and European markets were the kind of front runners in the ESG space, and they've been focused on this for decades at this point. The U.S. has definitely caught up in recent years, and in some ways have leapfrogged in certain instances or lagged in others. I think the investor community has really led work in the U.S., whereas there's a lot of regulatory pressure as well in the EU. And I think recently what we've seen is Asia has been exploding in terms of interest and focus on ESG. And so I think, it's still in the early innings, but we've seen a huge amount of really small investors in Asia that are starting to integrate this into their processes. GPIF has definitely led the way in terms of their business. And so I think we'll see a corresponding increase in corporate disclosures because it's kind of the cycle of how the market demand and response works.
Okay, great. Thanks Megan. So I think we have time maybe for one more, and I apologize, we did not get to all of them. I appreciate all of the questions. But the last one that came in here, could you please comment on the adequacy of combining E, S, and G metrics in one score?
I could probably take that.
Okay.
I think it's just a matter of, so we put certain weightings on our pillars, dependent on the industry that specific company is in. So if it's more of an energy company, there'll probably be more of a weighting towards that environmental pillar. But it's just a way to holistically look at how a company is doing overall. And like we mentioned earlier, the client has, whoever's using the data has the full ability to use as much or as little as the data as they want from a holistic view or a drilled down specific kind of carbon or energy type scores there.
Okay, thanks, John. E, S, and G are obviously, can be three very different things. So we obviously, Refinitiv offers, the combined score, which we make fully transparent. But as John said, you can look at it at a granular level as you think is most appropriate. So at that, it is the top of the hour. So I would like to thank our speakers, Debbie and Megan and John. Thank you very much. Thanks to everybody for participating in our webinar. There were some questions we didn't get to. We will certainly answer them, and everybody will receive the link to the recording as well as the slides. Thank you very much, everybody, and have a great day.
Thank you.